Well, not only on this little show do I talk about investing in shares, we also need to talk about investing in property. There will be times where we invest in other things. But I got a message come through. Hi, Glenn. Could you please record a podcast discussing the steps involved to list your current place of residence on the market as an investment property? No, I can't do that. I'm currently living in my own unit and would like to live closer to work, so thinking of renting it out and renting somewhere close to my office. Okay, so you're joined today by Rachelle Kroon. You host the This Is Property podcast. And this series is brought to you by the Quick Start Guide to Investing book. No other real ads or sponsors on this, just want to promote the book. What are the steps to take if we're living in our home residence and we want to move out and put a tenant in there?
Yeah, so I think the first steps from my perspective would be to have a valuer come out, and your mortgage broker can organise this for you, your bank can, and get a valuation done of your property. So it's really important to put a stamp on that and say, this is when it became an investment property and this is what it was worth at the time. Now, the reason for that is to do with capital gains down the track. So it has been your principal place of residence, but the purpose of that property is going to change. So important to do that. Some other things that I may consider would be to get a depreciation schedule done, because there might be things that are tax deductible in that property that you haven't considered before. If you bought this unit to live in, you may not have got a depreciation. Actually, you probably wouldn't have got a depreciation schedule done.
And you may have put a new oven in or range hood or ceiling fans.
That's right.
Yeah.
And you can talk to your accountant about that. The other thing I'd do is have a chat about the mortgage that you have. Now, there's no rule that says you have to change your home loan to an investment loan at the time you move out. There's no rule about that. You're not doing anything wrong if you leave the mortgage the way it is. It becomes tax deductible from the moment it's an investment purpose. So you don't need to change the loan, but a lot of people do change the loan at the time they rent it out.
Why do they? Because it's not like I'd never really changed mine.
Yeah, well, generally people go, well, now it's an investment property and I've been paying principal and interest and I've got 24 years left on this loan term. Well, I might now decide to pull that loan term out to 30 years and put a 5-year interest-only portion on it, because if you're going to be, I don't know, maybe buying another on your owner-occupied down the track, your preference might be to keep those funds in offset rather than actually pay it off the loan, because you've got to think this is now a tax-deductible debt, so it all changes. So you really want to review your mortgage at the same time as you make that an investment property. So reviewing your mortgage, making sure you get a valuation done and get a depreciation schedule if it's relevant for the property.
And I've just drawn, while you were talking there, an example of the valuation. I think the fourth thing is probably around maintenance.
Yeah.
So if it does need new carpet, for example, or a lick of paint. So there's two things here. And again, I need you to have a good accountant when you're dealing with this stuff. But in the ordinary course of life, business, investment properties, and tax, there's usually two kind of buckets. There's almost an expense type bucket or a P&L item and a balance sheet item. Okay. And this is where it gets a bit crazy, but go with me. If you do any general maintenance, so, okay, I've had to get a tin of paint and do some touch-ups. That $80 tin of paint, you would likely claim on your tax return the full $80 for that year, yeah? However, if I spent $2,000 on new carpet, I wouldn't claim that whole $2,000 in that first year because it would go into a depreciation schedule as it's a balance sheet item, for want of a better word. Is that a fair statement with the buckets, or am I totally?
Yeah, so I would always go to my accountant for that advice, and they would generally say, "This is what maintenance have you done? Well, this is how we'll depreciate this one down, and we'll write that all off this year."
Yeah. So on that, if they think, oh, the carpet's rubbish, I know that I need to get new carpet or do some handyman stuff. Can someone pay for that before the tenant goes in claim it or add it to the depreciation pool straight away?
Now, I think there's some, and this is definitely an accountant question, and we actually had an episode on the This Is Property show with an accountant recently.
Okay.
And there was some, they actually
We'll link the video if we've
linked
got
some
it.
video because that accountant actually put some tips and had all of this covered in
Great.
it. But off the top of my head, I think you would still, I think there's definitely rules around when the property is available for rent. So there's a difference between I'm going to rent my property out, the tenant moving in, and when it's available to rent. So when the actual, and I know I'm working mortgages, so I know factually that the interest is tax deductible from when that's available to rent. And you need to have, maybe a management agency agreement to say you're renting the property out, and it's got to be advertised and available for rent.
Yeah. So that's probably what you need to do. Give it a clean up yourself, get some quotes in. The moment it goes up on Domain or real estate, send the trades in and pay for it.
Yeah, and I think the big thing I would do if I was going to be renting my property out would be pick up my phone and call my accountant as well as because the accountant doesn't want to hear it about tax time next year.
Yep.
They want to be able to tell you before you rent your property out, do these things. Here's somebody to do their depreciation schedule, and this is the little rules around those capital works.
Yeah. So just back on the importance of getting a valuation, I've made a bit of a thing to work people through. We'll assume that the unit in 2020 was $500,000. In 2025, this year, valued at $800,000. In 2030, 5 years' time, when they sold it, it was worth $950,000. Now, if we get the valuation this year, the week, the month that we turned it into an investment property, that $800K value at 2025 is the cost base. So any growth between now and 2030 when we're selling it, and it's going to grow to $950,000, we only get assessed at the $150,000 as the gain.
But if you were to not have a piece of paper, if you don't have that valuation on file and proper documentation to say it was worth this at this date, there's another formula that's used, and that might work against you.
That's right, because they've got to work. There could be assumptions, but the worst case scenario is that they use the cost base of when you purchased it at $500,000, which is a $450,000 gain.
Yes.
Worst case scenario, but that is why you get a valuation. Now, I don't know what the actual tax law says around this, but maybe a real estate valuation.
I would get a bank valuation done.
A real estate one will probably be higher.
See, the thing is, your mortgage broker will get your bank valuation done without a cost. You shouldn't have to pay for a valuation. You're probably paying some.
They're not really allowed to give them out, are they?
Well, they are.
Oh, are they?
So they are allowed to give valuations out. So you can do a real estate agent will do like the property report, but a proper bank valuation is something that you can keep on file.
Yeah, and that's going to be more verbatim because they're a certified valuer.
Yeah, so a real estate agent's more of a property marketer.
Yeah. And then I think in this day and age, just pay a managing agent. Don't try and take over the world. You should get it for under 8% plus a bit of GST, between 5 to 8% maybe, management fee.
Yeah, and it's tax deductible.
Yeah.
And you get a nice little piece of paper at the end of the year that says, here's all the costs in and out. And the other thing is to get your insurance and all of those things, get that to go to the property manager.
Oh, yeah, my council rates goes to the property manager.
Yeah.
Anything I need paid for the property goes to the property manager. They pay it out of the trust account. And at the time of recording, we've just ended a financial year. I've just got a big statement. Here's your investment properties that we manage. Here's the consolidated report. Income received, expenses paid, net to you.
And all I do is forward that email on to my accountant with the interest
Yeah.
from the bank, and that's it. That's all I have to do at the end of the year. So if you can make it easier for yourself and have a professional do it, amazing.
Now, if in doubt, I want you to speak to a couple of managing agents. If you've been a renter and you remember an agency locally to you that you used to rent through and they were the most annoying pieces of crap on the planet, don't dignify them with your business as an our property owner. I've shared on this podcast the experience that I had leaving a property here in Newcastle, and I told them, like, me as the tenant, what you have asked me to do is the most petty thing I've ever experienced on the planet, without a lie. I've got multiple properties myself, and I would never let you manage them because the way you've treated a tenant, I don't want anything to do with you. So interview a couple of agents. If in doubt, ask the Facebook group, hey, and just keep on top of it. You know, you just treat people as you would like to be treated. I think it is reasonable to at least increase the rent every year by inflation or a little bit, just so they know that, because you might get caught out and it's really moved, but we're not screwing people. But look, I think that's a good help. Valuation, do we need a depreciation schedule? Speak to your broker to do any loan tweaks. Maintenance, if we're going to do that, we want to make sure we pay for it and the receipts dated, etc., after it's available for rent, and get a good agent in your corner. And probably sixth, the bonus point, make sure you get some type of landlord insurance.
Yes.
We've just done a heap of episodes. Terry Shear, they haven't sponsored this exact one, but I've just got a heap of money for them advertising the product. I use them myself. Insure your asset, because if the tenant skips town or burns something accidentally, you want to make sure you are insured.
You do.
So there we go. Thanks, Rach.
Thank you.
We'll see you soon. If this has been helpful, please feel free to send it to a friend and family member. Otherwise, you can hear more of Rachel on the This Is Property podcast. My name's Glen James. Bye.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive Pty Ltd, the publisher of this podcast, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds financial services license 451289. Opinions or comments from any guests on the podcast are theirs and not those of the host or the publisher or their respective license holders.